Hello everyone, Carey Koele here alongside Brent Kehrwecker. Thanks for taking a few moments with us today.
As we reflect on the first few months of 2025, it's clear the markets have already taken us on a bit of a ride. If we had recorded this video back in February, we would have been talking about how the markets had just reached new all-time highs. But as markets often do, they quickly remind us how fast things can change. And we've experienced that firsthand this year, with markets pulling back significantly from their highs. At their lowest points this year, we saw the S&P 500 drop as much as 21%. Dow Jones dropped as much as 16.5%, and we saw the Nasdaq drop nearly 24%. Here's the good news. We've seen some recovery since then. As of April 30th, the S&P 500 is down approximately 5%, the Dow is down approximately 4%, and the Nasdaq was down approximately 10%.
Market volatility, while uncomfortable, is completely normal. It's part of how markets work over time. As Warren Buffett once said, the stock market is a device for transferring money from the inpatient to the patient, and that patience is what truly builds wealth.
Several factors have contributed to this year's pullbacks. The major driver has been the global tariff tensions. New tariffs have created uncertainty around how much they'll impact the economy, from rising costs to disrupted supply chains, sparking market volatility across industries. These kinds of policy shifts can lead to short-term pain, but are part of the normal market cycle.
As we look ahead, there are a few important factors we're keeping an eye on. On the positive side, if inflation continues to ease, if interest rates start to come down, and if corporate earnings remain strong, those could all help drive the market upward. Consumer spending and continued innovation in areas like technology could also give markets a boost.
On the other hand, there are risks we're watching too. A slowdown in economic growth, rising unemployment, or renewed tensions in global trade could pressure markets further. Additionally, shifts in fiscal or monetary policy could introduce new uncertainties that impact investor confidence.
The important thing to remember is that markets have always faced uncertainty. What matters most is having a long-term plan that isn't based on predicting headlines. It's based on staying disciplined through them. In times like these, it's tempting to go into defense mode, but sometimes the best response is to go on the offense. Here are a few smart moves worth considering right now.
First, consider maximizing your retirement contributions. If you are able, increase your 401k or IRA savings. You're currently able to buy more shares at lower prices.
Second, contribute to a Roth IRA. If you're eligible, it's a great way to lock in tax-free growth while markets are temporarily lower.
And third, consider a Roth IRA conversion. Moving pre-tax dollars into a Roth IRA now could save you significant taxes on future growth.
We know market downturns can stir up emotions, but they can also offer opportunities for those who stick to their plan and make wise moves.
If you're wondering which of these strategies might make sense for your situation, give our office a call. We're always here to help you think long-term.
Thank you for taking a few moments to watch this video. We hope you found it helpful. Please take a moment to like and subscribe to our YouTube channel. It's a great way to stay updated with more helpful information. And if you haven't already, check us out on Facebook for more insights, resources, and news.
We appreciate the opportunity to connect with you and look forward to talking with you again soon.